guys, welcome to Talking Money with Nosy, personal finance made simple. This video is part 2 of last week's video about how the stock market works. If you didn't watch part 1, please watch it first by clicking the link on the top right hand corner of your screen right now. Let's get started with part 2. There are 2 things that you should know about the stock market. If you can understand and grasp these 2 things, you're going to be a very good long-term investor and you will avoid losing money. Number 1, over long periods of time, the stock market in general always goes up. Number 2, the stock market also goes down from time to time, but it doesn't stay down. And remember, when I say the stock market, I'm referring to the indices like the top 40, S&P 500, etc. I'm going to use Google Finance, which is one of my favorite tools, to show you that stock market indices as a whole go up over long periods of time. So let me click on that link, Google Finance, and I'm going to start with S&P 500, an index tracking the stock market performance of 500 large companies listed on exchanges in the United States. I'm going to compare that with the FTSE 100. So the FTSE 100 index, this is a group of the London Stock Exchange's 100 largest companies. Let's add the ASX for Australia, the ASX 200, hopefully it's here. Here we go. ASX 200 is Australia's 200 largest companies. Let's add the Hang Seng. This one is a group of China's 64 largest companies. Finally, let's add the DAX. DAX is Germany's index, so I think it's got 40 companies in there. I can only compare 5 things at a time. So let me just click on Max to show performance over long periods of time. So there you go. As you can see, over long periods of time, the stock market indices show positive returns. So the longer you invest your money in the stock market, and by the stock market, I'm talking about if you choose an index like the S&P 500 or the DAX or whatever it is, if you invest long enough, those indices go up. So therefore, you would make money. Let's look at the South African top 40 index as well, and you'll see that it has also gone up over time. So I use this website called tradingeconomics.com, and this is the top 40. So these are South Africa's 40 largest companies. We are seeing their performance over long periods of time. And you can see that the markets do go down from time to time, but the trend is going up. Same thing for the rest of the indices. There are bumps along the way, but the markets as a whole go up. Because the stock market indices always go up over long periods of time, you could simply buy ETFs like the S&P 500 ETF, the JSE Top 40 ETF, for example, and your money will grow as the markets grow over the long term. Simple. So why does the stock market go up over the long term? The biggest reason why the stock market goes up over time is because businesses get bigger and earn more money over time. Being an investor in the stock market means you get to take part in the profits that those businesses make. You benefit from their profits and their growth. And this is why I allocate most of my money to ETFs like the S&P 500, Top 40, and global ETFs. Because when I buy the ETFs, I'm investing in the stock market index, and the stock market index goes up over time. I want you to remember this point and keep it in your mind and repeat it over and over again, especially when times get rough, because it does get rough. If you're a stock market investor watching this video, you know that we are in rough times right now, right? This brings me to the next point, which is this. When you invest in the stock market, your investments don't simply go up every year. Definitely not. When you invest in the stock market, you always get a combination of huge growth followed by losses. That's just how it works. Why do markets go down? Basically, it is because of the law of supply and demand. If many people are buying shares at the same time, demand increases, the prices of shares go up, and the markets go up. But if many people are selling their shares at the same time, demand decreases, the prices of shares go down, and the market goes down. What would cause people to sell shares at the same time, causing markets to drop? What would have happened? People do this when they are scared, uncertain, or pessimistic. The biggest stock market crash in American history was in 1929 when the market fell by more than 80%. This was due to low salaries, too much debt, struggling agricultural sector, and there was also a collapse in money supply. When this happened, thousands and thousands of people got scared at the same time, sold their shares at the same time, causing the markets to fall by more than 80%. Guys,
the Great Depression lasted roughly a decade. It's considered the worst downturn in the history of the industrialized world. It began on October 24th, 1929. On this day, known as Black Tuesday, the stock market bubble burst. After years of reckless investing, a huge sell-off began with a record 12.9 million shares traded. During the Great Depression, unemployment rose 24.9%, wages slid 42%, and real estate prices declined 25%. The total U.S. economic output fell by 30%, and many portfolios became worthless when stocks dropped to only 10% of their previous highs.
Another big stock market crash that you may be more familiar with happened in the 2008 global financial crisis. The events that led to the stock markets crashing in 2008 were that in the years 2002 to 2007, more and more Americans were buying houses that they could not really afford, especially in poor working class cities. Because of low interest rates, the economy was booming, the banks were being generous. When the Federal Reserve started raising interest rates to control inflation, it resulted in higher and higher monthly payments for the houses. More and more borrowers found themselves unable to pay for their houses. Banks started repossessing the houses, and suddenly the banks had a lot of houses in their hands, but very few buyers to sell them to. It became a global crisis because many of those loans given to the American house buyers were sold by American banks as investments to other banks in other parts of the world. So those bad loans traveled all over the world, and when people stopped paying for their home loans, it affected banks everywhere.
The Great Recession, which started back in December 2007, is considered the biggest financial calamity since the Great Depression of 1929. It was caused by unsustainable debt, which led to the subprime loan crisis. Simply put, banks got greedy and lent money to people they knew would have a hard time paying them back. Furthermore, those loans were packaged and sold as financial products on international markets. Rating agencies considered them extremely safe, and reckless investors bought them without blinking. Insurance companies also got greedy and through credit default swaps promised to reimburse investors if something went wrong. Unfortunately, the inevitable happened and borrowers ended up no longer being able to pay the loans back. Needless to say, this caused the entire financial house of cards to collapse. Banks, as well as huge insurance companies, ended up on the verge of bankruptcy and were eventually rescued through bailout programs.
The most recent stock market crash was in March 2020. The markets crashed because investors were worried about the impact of the COVID pandemic. This virus came out of nowhere, started infecting and killing people all over the world. There was no cure. We were forced into lockdowns. People lost their jobs. People were like, we all gonna die here. And they sold their shares and boom, the stock market crashed. The markets crashed again in June this year. They recovered a little bit in July, but now they seem to be going down again. This is because of fears caused by high inflation. American inflation at the moment is 8.5%. It has never been this high since the 80s. European inflation is about 9.8%. This is the highest in history. South African inflation is 7.8%. It has never been this high since 13 years ago. Because of high inflation, the cost of living is going up, and the reserve banks all over the world have no choice but to increase interest rates to try and bring down inflation. Increasing interest rates means people's debts like car loans, home loans are also rising, so people all over the world are in a state of fear, a state of pessimism, and it is no surprise that the stock markets as a whole are going down. Now you know that the stock markets crash from time to time, but you also know that markets always go up. Why? Remember what I said to you. Markets go up because businesses get bigger and earn more money over time. This growth, however, does not happen overnight. It happens over many, many years. That's why you should never invest with an overnight mentality or get rich quick scheme mentality, because you're going to be disappointed. You must invest with a long-term view in mind. That will make you comfortable with the fact that markets can go down temporarily, but they always recover in the end because we have history to prove it. This is why I personally get excited when markets go down, because ETFs go on sale and I buy them at low prices, and when the market recovers, my ETFs also recover. But when it comes to individual shares, be very, very careful. When you invest in individual shares, the share price could fall because of a problem with the company. Companies can face challenges that cause them to lose money or go out of business. If a company is no longer making money or goes out of business, the value of those shares will drop, sometimes to zero, although it's very rare. That's why it is important to do your research and find out why the prices of your shares have dropped. If your shares are worth less because the company is struggling or going out of business, you should try to sell your shares. If the value of your shares is going down because of things like inflation or a recession or COVID, your shares could recover once external conditions have improved. So you should hold on to your shares and not panic sell. Let me conclude by saying this. Stock markets always go up, but they also go down from time to time. You can't avoid it, but you can avoid losing money. You can avoid losing money by, number one, buy ETFs that represent the market. ETFs are groups of many different shares, and you know that there is strength in numbers. If one company fails, at least the other companies within the ETF will continue growing. Number two, if you choose to invest in individual shares, do your research first and buy shares of good companies that do different things. For example, if you buy shares of 10 different companies and one company goes out of business, you can sell the share of that particular company that's failing and hold on to the 9 good shares. Number three, have a long-term mindset and avoid panicking when markets go down. Investing is not going to make you rich overnight. The market always goes up over many years, but on its way up, it also goes down from time to time. It's a fact that you have to accept. If you cannot accept this, maybe the stock market is not for you. You can try other investments like property, for example, but don't be fooled. There are no risk-free investments. All right, guys, that's it for part 2 of how the stock market works. As always, if you want to start investing and you need step-by-step guidance on how to open an investing account and how to choose shares or ETFs for investing, please go to my online store to buy copies of my ebooks for beginners for just 25 Rand each, guys. See the link to my store in the description below. Also, please give this video a thumbs up and subscribe to my channel. Until next time, bye guys.